Hey guys, welcome along. Just thought we'd do a video today, a bit of a long form video in terms of tax planning for the 2020 year and beyond. We're in the latter stages of doing our tax planning meetings with clients for this year, but there's still a lot of businesses out there that are a little bit unsure as to what they should be doing in terms of the COVID stimulus. Various bits and pieces there, as well as the announcements around the instant asset write-off, etc. So I thought we'd clear a few of those up. I'm going to take you through the next half hour, 45 minutes, just in terms of what needs to be done pre-30th of June and things to be looking out for as we move into the next financial year, as well as a bit of an update in terms of current bits and pieces. Okay, so let's get straight into it and start talking a little bit about what we're going to cover. So what I thought we would cover is, first of all, an update on the latest on the stimulus measures. We'll talk about monthly declarations for JobKeepers. There's been a few questions on those. Some end of financial year requirements, and also start looking at what to do when stimulus ends. Going to talk a little bit about tax time for this year, as well as tax planning. And then maybe some questions and some answers to some things that people are asking at the moment and getting a little bit confused over and need a little bit of assistance, and you may be in that boat. So first of all, just a bit of background on us. If you're not familiar with us, my name's David Ross. I run an accounting business called Direction Accounting, and also a business coaching company called Supercoach. Both of those businesses and the work that we do within those businesses has been the evolution of 19 years in business. We know a thing or two, and we do some great work with our clients. Some words of wisdom from Kerry Packer. A lot of you will have come across this. Kerry was once quoted as saying, "Of course I'm minimising my tax. If anybody in this country doesn't minimise their tax, they want their heads read. Because as a government, I can tell you, you're not spending it that well that we should be donating any extra." And what we do with clients when it comes to tax planning and tax is, we're not the tax man, but we're also there to protect your interests. We're there to make sure that you claim what you're entitled to do under the law, no more, no less. We certainly aren't the dodgy accountant that your mate at the pub will tell you about, but we're also certainly accountants that will make sure that we look at the law, interpret the law to your situation, and make sure that you are achieving the maximum result that you possibly can through the process. So it's very important that you get good advice. Don't believe the guy over the fence, don't believe the guy at the pub, and don't believe the keyboard warrior on social media, because legislation is quite complex. Even for really simple things like claiming home office deductions these days, there's still complexities in what you need to do. And a lot of people misinterpret those and give different opinions, whether they be over the fence, at the pub, or on the keyboard. And it all comes back to an individual's circumstances, because the person next door might have a totally different set of circumstances to you, and that may mean that they can claim something and you can't. So it's very important to get good advice. We also operate in Australia in what's called a self-assessment system. And the self-assessment system means that you can claim whatever you want, and it's not until the tax office knock on your door and audit you that they'll refuse the deduction. So very important that you don't claim that bright, shiny red Ferrari and think that you've got away with it, because if they do knock on your door, then they'll knock it back. A lot of people think that, oh yeah, my accountant claimed this, my accountant claimed that. Oh yeah, well, I claimed this, I claimed that. I got a deduction for this. Well, you got a deduction because of self-assessment. Whether that deduction will be sustained will depend on whether you get an audit or not. So in many cases, there's some very substantial amounts of tax can be involved, And because of the complexity, it's always good to speak to a good accountant or a good advisor and get the right information the first time round to avoid those problems. So what's the latest on stimulus? So when we look at what's happening in this space, the ATO have continued to have delays on paying out cash boost. Most businesses have received, but there are still some who haven't, and the ATO aren't forthcoming with information as to why. We're continuing to have to pursue those with the ATO in terms of escalation requests and continual queries. New South Wales government grants have also seen delays. There's a 30th of June deadline ticking on that one, but we are seeing grants that were applied for a month or two ago are still being delayed in terms of being paid. So be patient, be kind to your accountant or your advisor. They're doing the best that they can to get the money, but most of these systems don't have the ability for them to check the progress of where things are up to. The other thing I'm seeing a lot of is people who are not claiming the stimulus. So if you are entitled, please get in touch as soon as possible, because you could be missing out on vital money for your business that could be the difference between your business surviving this period. Even though restrictions are being eased, we're still finding that some businesses are still in real trouble in terms of cash flow. So it's important that you are getting what you're entitled to, and that we put aside this Aussie aspect to our businesses, and that's, oh no, look, we'll be right. We don't want to be greedy. It's not a matter of being greedy. It's a case of actually getting what you're entitled to. That's what the money's there for. So some myths on claiming. There are some people who are thinking that because their revenue's increased, that they no longer pass the test, the revenue test of a decline of 30%. So therefore, because business is now going well and they've reopened, that they no longer pass and are no longer going to be eligible. That's not correct. Once you pass once, you pass for the full 6 months. I'll come back to some possible changes in a moment. A lot of people are thinking that they're only eligible in a later month and ignoring where they may have been eligible prior. So particularly people who may have had a poor May and June possibly should have been registering using the quarter as the measurement. And a lot of people are thinking, well, okay, I'm only going to be eligible in, say, July. Well, that's fine. Register in July and become eligible in July and claim July, August, September. We talked about being too greedy, which is what we're seeing a lot of people sort of shy away from money that's otherwise there to help. And there's also businesses that still feel that they can hold off on paying their staff until they get their JobKeeper money through. You must be paying your wages first and then claiming in arrears. There have been some recent announcements around the home builder stimulus. ScoMo loves you can tell he used to work in marketing, he loves a reference. We've got JobKeeper, Job Seeker, Home Builder, Job Maker. Everything's got a name for it. But home builders there to help the building trades industries with $25,000 payment direct to the consumer, and it's to do with new builds or renovations. And $750 is the magic mark in terms of value of property, and it will allow you to either have that $25,000 towards new build or towards renovation. One of the problems with that is going to be the contracting to build. And I've had some comments made to me by people in the industry that they're going to run into problems with the time frames in and around finance. So you can't use the $25,000 as part of a deposit. for instance, and also then around the approval of DAs, etc., taking longer than the period that this is going to be available up until December. There's been talk of some JobKeeper changes coming on July 23rd. That's when a review is released into the JobKeeper system. What those changes will be, we don't know. There is talk of the issue around passing once and not having to pass on an ongoing basis being changed. That's probably a likely result. But at the moment, once you pass once, you're eligible for the full 6 months. There's also the possibility of JobKeeper being changed in terms of the industries that it's going to be applied to. So we'll just have to wait and see what they come up with on July 23rd. If you are in the JobKeeper system already, then you need to be doing a few things each month. You'll probably already realise that, having recently done your May declaration. Satisfying the wage condition is important. As I said, you've got to pay your wages per fortnight. Also have to confirm, identify your eligible employees, each declaration. If you're in the STP system, all that will be being pre-filled, and then you have to confirm that. However, what you can be doing is adding employees if you aren't in the STP system. There's also the requirement to disclose revenue, both for the current month, the testing month that you're declaring for, and then the next month after that, which is a forecast. They're only disclosures for information purposes, but you can bet that if they do change the rules on the 23rd, they're going to use that information as a basis for how your business is going and how it's improving. So some end of financial year requirements and also some questions that we're getting a lot of. So the first of those is JobKeeper assessable income? So JobKeeper, when it comes into the business, is assessable income. There's no GST applicable, but it is assessable income to the business. Much like the wages that it's replacing or reimbursing are deductible to a business. Is a cash flow boost assessable income? So cash flow boost is the pay-as-you-go withholding that comes through on your BAS. That's not assessable income. No GST and not assessable income. A lot of people have been getting New South Wales COVID grants. Are they assessable income? And the answer to that is, yeah, maybe. So the bushfire grant, there's an actual government announcement that said that the New South Wales bushfire grant would not be accessible because it comes under disaster. Okay. However, the COVID grant is not coming under that exemption, and as a result, the advice that we have at this stage is that yes, it is accessible income, but watch and see on that one in case there's anything else released. Is the super that you accessed via the COVID stimulus, is that taxable to you individually? The answer to that one's no. That comes out tax-free. If some of this money's going into a company or a trust, if you operate through a company or a trust, and the money is going in as tax-free, so cash flow boost, New South Wales grants. New South Wales grants are a bit different. It's got to be spent on certain expenses, but the cash flow boost just comes in. And then we want to get that money out of the company, or out of the trust. So we've got to really think about how we get that out in a tax beneficial way. So if you're in that boat, company or a trust, please get in touch and we can help analyse what you need to do to be able to get that money out to yourself as shareholders, directors, as opposed to it just sitting and remaining in the company. A few little tricks that we can do there. Make sure you look at your stock take, get your stock take done. There are some concessions there for small businesses in terms of a movement of less than 5,000. But we really, it's good practice to have your stock take done each year, particularly if you're a retailer or you're holding large stock holdings. The other thing to look at is writing off bad debts, particularly relevant now. However, there are requirements around proving that the debt is bad, as opposed to just writing off a whole heap of things and then writing them back in a future period. So really look at any debts that are doubtful and then go through those and say, well, okay, have we exhausted all means of being able to recover those debts, and then write them off before the 30th of June, so as we're not paying tax necessarily on money that we haven't received. If you've got more complex tax matters, then you really need to sit down with your advisor. And as I said, we do tax planning each year, have been for over probably 15 years with our clients, been doing formal tax planning meetings. So if your business still hasn't got to that point, we do have a few spots still left in our tax planning schedule. You need to be quick to get in because there are some key dates over and above 30th of June, obviously, that need to be met. One of those is Superannuation Clearinghouse, which is the 23rd of June. So if we want to do some stuff in terms of our employee super through the clearinghouse, then we need to get that sorted and settled very, very soon. So what's your plan when stimulus ends? We do a thing through our business coaching arm, Supercoach, with businesses where we do a needs analysis for new clients and also existing clients, where we ask a whole heap of questions, whether something's a priority and how the business is actually going with that. And in that is a question in and around planning. And 90% of business owners who complete a prioritised needs review with us operate without a written plan. So they're just flying by the seat of their pants. And now's not the time to be flying by the seat of your pants, let me tell you. Now's the time where we need to have a plan in place. And we need to have an active plan, because what happens if something changes in a month's time? What happens if the rebound that we're all expecting doesn't occur? What happens if we do reopen with the restrictions easing, but things are very slow and it's not the expected bounce back that we wanted? So you need to be able to change your plan on an ongoing basis, but you need a plan in the first place. Sure, it might change, but if you don't have a plan, how do you know where you're going? How do you know what's likely to be on the horizon? So we talk to clients about business action plans, and this is a business action plan in a nutshell. We talk about your SWOT analysis, very important feature of any business plan. Cliched, sure, but the critical part to any good business plan. We talk about operations and finance, sales and marketing, people and procedures, and everything that comes with all of those categories. And then we also do cash flow forecasting and get a financial model behind your action plan. A couple of other things that we're doing within our business to go a bit deeper beyond the planning is launching our online learning hub. We're going to be launching that late June, and part of that will be an online business coaching course called Revive, Survive and Thrive. The reason we've named it Revive, Survive and Thrive is we believe there's still businesses out there where we need to get the defibrillator paddles out and shock them back into life. They're the revivers. So we want those to move through to survive and then through to thrive. Also, there's a number of businesses that are in survival mode. So they've maybe got through the COVID period. They're maybe now reopening and starting to get a bit of cash flow happening again. But they still need to make sure that they've got a good plan in place and that they've got somebody helping them through this process to keep them accountable. So they're our survivors. We don't want them to retract back into revive mode, and we want them to progress through to thriving. And then we've got our thrivers, the guys that really haven't been hit yet. And I say yet because I think that there's some issues to come. But we want our thrivers not to move back into just surviving. And we want our thrivers also not to go even further back to having been revived. So this is going to be a bit of a centerpiece of our learning hub, and a program that I'd really encourage businesses to get involved with, because it's going to allow you to access business coaching on your time frame, because there will be a online learning component to that, but also a face-to-face component and some Zoom sessions, group sessions, to be able to keep people involved and keep connected within the business, because sometimes the best ideas come from other business people. And that's what we've found as we've run these types of programs in person in non-COVID times. So what we all wanted to hear about, some more tax stuff. We've all got to get excited about tax, don't we? Okay, the basis of tax and deductions is what they call Section 8.1 of the Income Tax Assessment Act. And all that's really talking about is that to claim a deduction, it needs to be necessarily incurred in producing assessable income and not be of a private, domestic, or a capital nature. So let's break that down a little bit. Necessarily incurred. That means that you've actually got to incur this for business. It's not something that has such a long bow to draw to actually incur it for the business. Okay. In producing your assessable income. So it can't just be incurred as a deduction without having a connection to the income that that deduction is related to. Okay. So there's some really interesting things that have been claimed, and I'll go through those in a second. It also must not be of a private, domestic, or capital nature. Now, a private nature, pretty obvious. It's going to be something that's personal, not work or business related. Domestic is something, again, that is a personal aspect to it. Okay, so something that's just merely your living rather than something that's you're earning an income. Or of a capital nature. So there's a lot of grey areas in and around something that may be an expense, or maybe something that becomes something that's what we call a capital account. So think of, let's say you have an investment property, repair your toilet, a broken toilet, that's a repair, that's an expense, necessarily incurred as part of producing assessable income on the rental property. However, if you replace the whole bathroom, in most circumstances that will be of a capital nature, because it isn't replacing or repairing, it's actually changing the function of the whole thing. Or if you put a patio on out the back of your investment property, that's capital. And that goes towards the cost base of the house. Now, there are some write-off abilities there. We won't go into those now, but that's basically giving you an example of what's capital nature. So now that we've worked through what the tax office requires of us in terms of a deduction, let's look at some interesting ones that I've had over the years. Had a client who ran a fishing tackle business, want to claim his swimming pool to test his fishing lures in. That same client wanted to claim the expenses for the pool cleaner, because while ever he was at work earning assessable income, he necessarily had to incur the pool cleaner to clean the pool at home, because he didn't have the time to do it. So both of those expenses, both the swimming pool and the pool cleaner, they're really private, domestic in nature. And there's a pretty tenuous claim to say that they're necessarily incurred in producing assessable income. Very tenuous. I call it the BS test. And basically, we're not the tax man. And if we think that it's a load of BS, then the auditor from the ATO is really going to think that it's BS. So as I said at the start, we're not the tax man, but we are here to make sure that you claim what you can legally, but not put yourself in a position where you're going to claim stuff and then get into hot water down the track. We talked about self-assessment. let's get into some specifics. So the big one for this year for a lot of people is going to be home office deductions. You've always been able to claim home office expenses. There was always one method, which was basically actual costs. You have to keep logs of the hours that you work. A long-winded thing that most people just put their hands up and went, look, it's all too hard. Or they took an approach of saying, well, okay, we'll claim this and see whether we get away with it. Not the way to necessarily do things. The tax office realised this and then brought in a shortcut method. And the shortcut method, the fixed rate method. And the fixed rate method was basically a set rate, a bit like cents per kilometre for a motor vehicle, 52 cents times the hours that you worked. And that would cover most home office scenarios. With COVID, the ATO have brought in from the 1st of March onwards a shortcut method which will allow you to apply an 80 cent an hour rate, and that will apply to cover things like phone expenses, internet expenses, decline in value of equipment that you may be using, furniture, desks, etc., and electricity or gas for heating, cooling and lighting. So you've got 3 ways of doing it now. So that's going to be something to look at as a claim for you, given that most people have been working from home for at least part of this period anyway. You want to be looking for any training or additional marketing that you've been doing during the COVID period. Again, that's claimable. We're still not at 30th of June, so if you are looking at doing any training or marketing, maybe that's a tax planning tip to get some of that in before the 30th of June if it's business related. Also look at the tech and the equipment that you've been using. If you don't come under one of these home office things, certainly depreciation or claims on your tech. We've got the instant asset write-off that can be used for business owners as part of that. Superannuation is always a good one. We're not giving specific advice as to whether you should or shouldn't put superannuation in. That's something you need to discuss with your financial planner. However, from a tax perspective, if you are looking at superannuation, individuals have a cap of 25,000 to take advantage of. Depending on your marginal tax rate, superannuation might be a tax-effective tool. You could put some money into superannuation. You will save your marginal rate. Let's say including Medicare, that was 34.5%. Then you might put $10,000 into super. That would save you directly $3,450. However, once it goes into your super fund, if you're claiming a deduction, it's taxed at 15%. So the 15%, whilst it's paid in the super fund, if you're looking at it as an overall picture, you'll get the $3,450 less $1,500 on that same $10,000. So the deduction's around about $2,000 overall. Or the tax effect, I shouldn't say the deduction. You don't need to put 10,000 into super. You can put any amount as long as you're within your caps. And I'll come to something about caps shortly. You can look at prepayments, so you can prepay up to 12 months rent, 12 months interest on loans. You can also pay your upcoming year's accounting fees if your accountant's amenable to that. We certainly are. If you want to pay some accounting fees, give me a call. You can also delay. So if we're talking about capital gains is done on a contract basis. So the only way you'll be able to delay there is to delay actually signing the contract. If you're just looking from a revenue income perspective, then timing is a big thing. If you're on a cash basis, then you don't want to be receiving prior to 30th of June. If you are on an accruals basis, then you don't want to be madly invoicing before the 30th of June. So timing has always been a big tax planning thing, but we do need to now watch with COVID because if you are combining a timing with trying to become eligible in the June month, then you may cause some problems with the ATO in terms of fabricating eligibility for some of the COVID stimulus like JobKeeper. So be careful there. And depending on what tax basis you're on, whether it be cash or accrual, if you're cash, you want to maybe not receive the cash, but you do need to have paid your expenses. If it's accrual, then you need to have been invoiced your expenses, but not necessarily have invoiced customers to get these kind of delays and timings correct for tax planning purposes. Some other strategies that are there from a tax planning perspective, you need to look at superannuation. There's some, this is the first year we can take advantage of some brought forward superannuation caps. Again, if you don't know what that is, get hold of your advisor. It's kind of beyond the specifics of that, beyond this presentation. The instant asset write-off, you've got up to 150,000 to play with. Now, most small businesses that we deal with won't necessarily be playing above that. 150,000, a lot of money to be able to claim. You wipe your tax bill out with one stroke of the pen. However, don't spend money on stuff that you don't need. Okay? If you don't need to buy that car and it doesn't make sense to finance a new car, then don't buy the car. We're big believers, and this is probably different to what a lot of accountants would say. They'd say, go buy the car, go buy that big screen TV. But if you don't need it, don't spend the money on it, because you're only getting your tax rate as cash back. You're not getting what you spend on the asset back from the government. And the other thing is that it's only smoke and mirrors. You're not getting anything that you wouldn't get over a number of years anyway. This is just accelerated depreciation. So to give you an example, asset worth $100,000. If you're operating in a company and you need to wipe $100,000 off your profit, you can go and buy an asset for $100,000. You can finance it. That $100,000 on company tax rates at the moment would be $27,500 you'd save in tax. Okay? But you would get that saving over time if your company is profitable each year. It's just bringing it forward into 1 year and compressing it. Now, I'm a big believer in taking the prize now and worrying about future years. So it is a valid thing. But if you don't need that $100,000 asset, why finance it? Why go into extra debt in the environment that we're in at the moment? So you really need to analyse that a bit beyond the media hype and the car ads that you see on TV. Company tax rate changes from 1st of July, 27.5% down to 26%. Now, beyond the obvious that there's going to be more tax saved this year than next year on a dollar basis on the same deduction, then beyond that, you also, if you're in the habit of paying dividends from your company and you have franking account balances, you're going to get more bang for your buck this year than you're going to get in future years when the tax rate drops. So a few things to be mindful of. Again, get good advice if any of those are going to affect you. So what do you need to be doing now? Good tax planning starts now. As I said, we've got a few spots left for tax planning sessions. Please get in touch with me if you do want to have a chat about the specifics of your business situation and book in for one of those. Then tax planning starts 1st of July. This year's been affected significantly by COVID in terms of tax planning. We've normally got all of our clients tucked away by now. But because of the impacts of COVID, both on businesses and also on advisors, tax planning season is going all the way to the end this year. But next year, start the 1st of July. If you're in a business and you're an individual business owner, even if you're just an employee, get yourself a receipt app, something like Receipt Bank or HubDoc. Get in touch with us if you don't know what they are. It keeps track of all of your individual receipts through the course of time. And you'd be amazed over the course of the year how many of those receipts either fade or get thrown in the bin, etc. And then you don't claim those expenses. So a little bit of money spent on an app like that is well worth it. Beware if you varied your pay-as-you-go instalment as part of the stimulus measures, that not only are you going to have to come up with your tax bill when it hits, for most people that's not going to be until next year, early next year. However, watch the double dip, because when you then lodge that tax return, the ATO is going to be wanting your instalments, maybe increasing, as well as the next year's tax is going to hit pretty quick on the back of that. So whilst it's been good to get that money, again, bank it while we can, then you need to watch when that happens into the next year. Review subscription software. So most software now, all cloud-based, people have 1,001 subscriptions. So review what subscriptions you've got, and now's a good time to have a bit of a clean out and get rid of some of those. Don't worry about the tax benefit of it, just get rid of them. If you're not using them, get rid of them. Or put a timer on the ones that you think you should keep as to whether you will use them over the next 3 months. You'll be surprised. 3 months will go pretty quick and you still won't have used it. Get rid of it. Stop paying for it. Review your cloud accounting system. If you're inefficiently using the product that you have, whether that be Xero, whether that be MYOB, whether that be QuickBooks, please get in touch with us. We're Xero experts over and above the other two, but all three products we can support you with and make sure that you're getting the most out of the product and getting value for money. Invest in your business skills and planning. Like I mentioned before, every business needs a plan. 90% of those that do our survey say that they don't have a written plan. So if you're in that 90%, reach out to us. Let's get you a plan to get through not only COVID, but also take your business into the next level when you get past the COVID period. If you want to get in contact with me for any of those things, especially tax planning, because that one's really time critical, our website's direction.com.au, or from a business coaching perspective, thesupercoach.com.au. We're available on all good socials, Facebook, Insta, Twitter. My handle there is at DJ Rossi. LinkedIn, just search David Ross and you'll come across me. Email address directly davidr@direction.com.au, or you can use the old phone and give that a crack and you'll get me pretty quickly. So I just wanted to finish on a couple of questions that we've had. A few people have been asking, should they finance a vehicle or should they pay for it outright prior to 30th of June? I'm a big believer if you can, in terms of financing. So the reason being is that cash that's sitting in your business that you would use to buy the vehicle outright is working capital. And you need to hang on to that now even more so. So financing is always the way to go. Car finance is usually fairly easy to get, particularly if you've been in business for a while. And the car's reasonably late model. So financing, I think, is a much better option. The other question that I wanted to cover here was just in and around superannuation. So superannuation clearinghouse, 23rd of June. If you want to pay your employees superannuation prior to the 30th of June, or if you put yourself through the clearinghouse as well, then you need to do that prior to the 23rd of June. The reason being is that the clearinghouse get the details, the payments then made, then the money goes to the fund. So all of that cycle takes time to happen prior to 30th of June, and to get the claim, it has to be on a paid basis. So you need to have done all of that by the 23rd of June to be able to get it through. Lastly, how much does tax planning cost? So a few queries have come to us saying, yeah, but can't we just use this information and go ahead and do it? And as I said, it's critical to get good advice. Most tax planning assignments that we do land somewhere between $1,000, $1,500. Some are much smaller because it's just a quick chat that we need to have to plant a few seeds, look at some figures pretty quickly. But typically what we do, the reason it's $1,000 to $1,500 is we look at your accounts, We prepare a set of management accounts from those figures that allows us to then do some estimates. We put together some schedules with some what-if scenarios, and then come back to you with, this is what you will pay if you do nothing, this is what you will pay if you apply certain strategies. And it gives you a really good handle on where you're going to head from a tax planning perspective. So hopefully that clears up a few of those bits and pieces. If you do want to avail yourself of tax planning, I'd say there's probably about 3 or 4 spots left. So if you want to jump on one of those, get in contact with me, and let's get some tax planning done for you ahead of 30th of June. I think it'll pretty much, pay for itself 10 times over. That's typically what we see with business owners. That's pretty much it for tax planning. If anybody wants any general information or wants to get a second set of eyes on their figures from an accounting or a business coaching perspective, again, get in touch with me. But for now, have a great day, and talk to you all down the track. Thank you.